Apollo Global Management, Workday, and Lennox all joining the S&P 500 today, replacing Corvo, Amentum, and Catalent in the index. Joining us now at Post 9 for more on Apollo and what its inclusion in the S&P could mean, TD Cowen senior equity analyst Bill Katz. Good to see you. You have a buy rating on the stock, price target 230. And stock's already ripped this year, hasn't it?
Yes, it is.
On anticipation of this and what's going to be a better environment for deal making and realizations and everything else seemingly that private equity wants to do.
Right. It should be a good year in 25. I think you have a lot of different drivers to the story. You have obviously the inclusion, which creates a nice little, I think, technical tailwind of just sort of passive-driven buying. I think you're going to get a revaluation of the stock, just given now that it's in the S&P, how investors value the company versus historically. And there's a significant number of growth drivers ahead of them into 2025.
What's not in the stock already? I mean, as I said, it's up. We're looking on the screen. It's up 85% in a year.
Sure. But the interesting thing is it's only 17 times 2026, and the market's much more expensive than that. So what I think is going to happen is the investors are going to start to look at earnings growth, where they should grow about 20% plus over the next couple of years, much faster than the S&P. And then I think the conversation starts to get to what's the multiple, what's the PEG ratio versus the market at large. And so I think that's a big one. What's in front of them is I think you see an acceleration of opportunity to grow into the retail democratization area, where they're selling their products into the retail, the individual investor.
Like alternatives.
Exactly.
That have become, all the rage in terms of where investors are looking to put their money.
They want to get into retirement. Why buy an Apollo versus a KKR or a Blackstone?
Yeah, I think they're all good. We're recommending all three of those. So two of those are my favorite names going into the new year, Apollo and KKR. And
we also like Blackstone. Different business, right, with the insurance inside?
Sure. The nice thing about Apollo, I think, for 2025 is it gives you a little bit of offensive, defensive play. If rates stay higher for longer, Apollo should do very well. And if rates come down as expected, the stock should do very well also. So you're getting a good opportunity of retirement, like you mentioned, a great opportunity in retail, great opportunity in yield, and all also on a global basis as well.
But how much of Apollo is private equity? How much is private credit? How much is the insurance business? Like, where does that 20% earnings growth come from?
Sure, it's a combination. So if you look at the company, say, roughly speaking, about half of it comes from the insurance business, half of it comes from the asset management business. As we look out over the next several years, the faster rate of growth should come from the asset management business relative to the insurance business, but they both should grow very nicely. So you'll see the biggest growth coming out of the asset management business and steady growth coming out of the insurance business.
Why hold ratings on Blue Owl and Carlyle?
Yeah, just valuation for us for the most part. I think for 2025, what we're looking for to really focus on the higher conviction calls. I do think one of the themes you'll see in 2025 is some differentiation of growth going forward. And we see some of the bigger players, Blackstone, KKR, Apollo, Ares, doing very well in terms of gathering assets in the retail space. I think Owl will have a very good year in that scope, but just from a valuation perspective, we see better depth of value with the other.
How do you assess the incredible growth of private credit as you look at potential risks down the road for any of these businesses that are making it a key part of their growth strategy?
Sure. I think it's going to be much more difficult for the smaller players to get in. They just don't have the same scale, asset quality, credit underwriting capabilities, and depth and deal sourcing. As we look ahead, the private market business is not as risky as people think. There's not as much leverage versus the banking industry, and there's very good due diligence here. So at the end of the day, credit quality still seems to be very good, and they're very well diversified across their portfolios.
You cover the exchanges as well.
Yes.
There's been, a lot of momentum around these names because of the expected pickup in trading activity.
Right.
We're talking about Bitcoin and crypto every day. We're anticipating a robust year for the economy, deal making, stock market, et cetera. But yet you have holds on both the CME and the NASDAQ. You rate the ICE, which owns the New York Stock Exchange, obviously a buy. So it's good that you're sitting here. But why the other two as a hold, if there's optimism about most of these businesses?
Yeah, I think it's just relative value, relative impact of what you're talking about. So from our perspective, we're also taking some of the macroeconomic dynamics into play. We like TradeWeb quite a bit on the secular growth of the electronification of the fixed income markets. And ICE, sorry, not to pander, but ICE is a great opportunity here in terms of the derivatives platform, futures and options, as well as a recovery on the mortgage technology side.